3, 2, 1.
All right.
Welcome to the show.
It's almost Christmas, bro. Get one more week for Christmas shopping.
I know. I think I'm done.
Yeah, excellent. I'm done.
But I won't get them wrapped till the night before, so it doesn't matter.
That's the way it works.
There's somebody in our office building here wrapping presents next week. I'm hoping to get a hold of that.
Yeah.
Then I don't have to wrap as many.
Yeah. Dude, crazy week. This is going to be I think it's the 8th consecutive up week for the market. 8 consecutive weeks. I don't know I don't know when the last time that was, but it wasn't any time in the last probably 5 years.
Yeah. Wasn't recently.
Pretty amazing. Yeah. Is that my phone doing that?
Mm-mm.
Yeah, so I got a lot of stuff to talk about on this podcast, and so let's just kind of get into it. So TSP Weekly Podcast, 17 December 2023. So before I get into all the stuff I want to get into, I came across this chart in somewhere in my feed during the course of the week, and it basically struck me as I'm trying to be as apolitical about this as possible, but all I've been hearing for the past however long is how we were energy independent essentially under Trump, and then Biden comes in and puts on all these restrictions, and you can't drill, and you can't this, and you can't that, right? So I get it, it's the narrative, and I'm allowing myself to be sucked into the narrative. But when I came across this chart, so this is a chart from the Energy Information Administration, and it was pulled up by Axios, right? Axios is the company, company that put it out on Twitter. Anyway, American oil production, already higher than any other country, is quietly setting new records and helping to push gas prices down. I wouldn't have thought that was true. But when I'm looking at the chart, right, the U.S. is in blue, and we're on this angle like this. It's almost the same angle as we're coming out of COVID. It's a little bit less, right? Coming out of COVID is a little bit less. So here's 2015, right? So here's Trump, here's Biden. Not a whole lot of difference there. And that's all I'm trying to point out. I hate getting sucked into narratives and finding out later that I got sucked into a narrative.
Unfortunately, it happens all the time to us.
Yeah.
I don't mean just us. I mean everybody. There's an agenda for most of the narratives, and you just have to know that when you're going in.
It's brutal. All right. So a whole lot of stuff happened this week. I got a little list. We're going to talk about that a little bit. And then if you're a bear or if you're a bull, what needs to happen in 2024 for your side to win? And then we'll talk about the Santa Claus rally. I was going to do that next week, but this Friday coming up is the first day of the Santa Claus rally, so I wanted to get the information out so that you guys could understand what everybody's talking about. Santa Claus rally has not begun. It's a very specific. It's the last 5 trading days of the year and the first 2 trading days of the following year. But we'll talk about that. And then I get a couple other charts in there and the C fund and the F fund at the end. So this has been such a long week. CPI came out on Tuesday. It was up a little bit, but the rental component, which is 30% of the CPI, actually rose. So I'm looking at that going, okay, that should make the Fed more hawkish, right? It's saying that a third of the inflation number is going up. A bunch of the other stuff came down a little bit, but a third of the component is moving higher. And I'm watching these different data points to anticipate what the Fed's going to do on Wednesday when FOMC comes out, right? So then on Wednesday, PPI, which is the other part of inflation, it was down to 2%. So while CPI was a little bit sticky, PPI was down to 2%. So if you wanted to be take the light most favorable, you could say, okay, well, one of the inflation gauges is down to the Fed's 2% target rate. Okay. So then Wednesday, we have the FOMC meeting, and Chairman Powell comes out and couldn't have been any more dovish. They call it dovish, meaning like Hawkish was when last year at the annual meeting symposium in Jackson Hole, he basically, apparently, literally tore up the speech that he was going to give, and goes out and doesn't have a speech, and he's like, "Look, I'm hammering you guys until the market comes down." Like that. That's really hawkish, and so the opposite of that is dovish, right? And he basically came out. If you watched it, he was like bebopping, like he was happy to be there and chit chatty and answering questions like it. He wasn't stressed over anything, and the market took off. He's never going to come out and say, "I'm going to cut rates and I'm going to do it tomorrow." That's not going to happen. But he may as well have. They immediately went from the market anyway went from pricing in 3 interest rate cuts next year to 7, and so that's where that rally comes from. And then retail sales comes out on Thursday, which is retail sales were better than expected, which means the economy is doing well, which is inflationary, which means the Fed shouldn't be so dovish. So it was a crazy week, but at the end of the day, huge rally. And the most important thing from my perspective is what happened. How did the rally look? Like who was involved in it, right? You get the Magnificent Seven, which have been leading this thing off the bottom in October, versus the equal weight of the S&P 500. So if you had the S&P 500, including the Mag 7, but if they were all equally weighted, what would that look like? So I got a couple of charts on that. So the candlesticks is the equally weighted S&P 500, and the orange line is an ETF that it's called MAGS. If you wanted to trade it, it's a combination of all the Magnificent Seven. And so the only reason I put out this chart, and the only reason it's as short as it is, only goes back to the 8th of November. It's a brand new ETF. So that's as far back as it actually goes. But you can see it peaked back here on the 20th of November and has been in this, I wouldn't call it a correction, but the equal weighted S&P 500 has been outperforming the Magnificent Seven, right, since around the middle of November, which means that broader, right? It's when they keep talking about breadth, market breadth. That's what this is. If the Magnificent Seven is flat to down, and the overall market is still rallying, that's a really good thing, right? It means it's not not as focused on those 7 stocks. So there's sector rotation happening, and the rest of the market is catching up. That's a really good thing. So this one is equal weight versus the S&P 500. So the candlesticks are equal weight. Okay, so that includes the Magnificent Seven, and the orange is the S&P 500. The S&P 500 is cap weighted, so it's just another way of looking at, okay, the Magnificent Seven had a negative effect on the S&P 500 overall versus the equal weighted S&P. So again, it's just saying that at least since I don't know, let's call it the beginning of December, since that day, maybe this day, that more breadth is coming into the market. The mega caps are taking a little break, but the slack is definitely being taken up by the rest of the market. So that's a really good thing. Okay. So the case for a bull versus a bear in 2024. So if you're a bull, you want Europe and China have been hammered for this year, 2022 and 2023. But you want to see a recovery in Europe and China, and that will enable the U.S. rally to continue. You want to see the Fed cut rates, which it certainly looks like they're going to do. You want to see the dollar fall. You don't want to see mega cap tech roll over, right? It may have gone flat for the last month or so, few weeks, but you don't want it to roll over. And you want that sector rotation, particularly small caps, outperforming. And that's kind of what we saw in the last couple of charts. So the bulls are in pretty good shape right now. If you're a bear, your perspective is continued weakness in Europe and China brings the U.S. down with it. And so you could be on either side of the fence on that. The Fed causes a recession by keeping rates too high for too long. It doesn't look like that's going to happen. There's still a lot of economists out there that think that the Fed has already broken the system. It just hasn't caught up yet. Maybe they'll turn out to be right, but there's no indication of that right now. If it does, it would be certainly some kind of banking crisis like we saw back in the spring. But again, no indication of that happening right now. Mega cap collapse brings down the S&P. It's possible, but because there's so much, it's so concentrated in those 7 companies. If mega cap tech rolls over, the S&P could certainly come down with it. And then relative weakness. The idea is that the relative weakness that we've seen in small caps versus the S&P 500 this year, if the small caps rolled over, the S&P would also go down with it. So kind of 2 different ways of looking at the world. But at this point, there's nothing that would make us think that this is the outcome. The bulls are in good shape right now. And so one of the things is the dollar, right? So like you said, if you're a bull, you want to see the dollar keep going down. So is it likely that the dollar keeps going down? So here's a chart of the dollar. Here's 2000, so it's a weekly chart of the dollar. All I did was connect the major lows and make this line. I copied this line, and this line is parallel to it. Okay, so the dollar's been in this channel, okay, since 2008. So this is a long-term chart. So it's been in that channel. It's still in that channel. And it certainly looks like it wants to continue down somewhere to around 95, right? These black lines are all the same length, okay? And so from this major bottom to this major top, that was the move in the dollar. It's the same from this major bottom to this major top, and this major bottom to this major top. Okay, so if the pattern continues, the dollar falls, something like this, and then we get another big spike up in the dollar, right? But in the short term, it absolutely, and I'll say short term, but it absolutely looks like the dollar wants to continue lower in some kind of A, B, C, back down, we'd expect back down to that trend line. So I'm saying the short term, but usually you have these spikes in the dollar, and it takes, in this case, it was 2009 to 2014, right? And then we had a big spike up in 2015, let's say, and it took until 2021 to get back down. So it could take, into 26, 27 before the dollar gets back down. And it doesn't have to go in a straight line, right? It can come up and do whatever, but it's going to be in a decline if the pattern continues for some significant amount of time, which is bullish for stocks, right? Because when the dollar is falling, stocks are going up. So that's definitely one positive for the bulls. And the other one that we said you want to see. So there were 2 arguments, right? If small caps, which this is the S fund, so it's small caps. If the S fund has been basically flat since, mid 2022. So if it's in this horizontal channel, you can say, okay, this is a 1, a correction for a 2, and the next move should be down. So if you're bearish, that's how you would look at it. And the way you would invalidate that is to have a breakout from that channel, which is what happened this week. So the alternative is that small caps start outperforming big caps and they catch up. And then even if tech rolls over a little bit, the small caps outperforming the C fund in general will keep the market moving higher. So this chart of the S fund is really bullish for the market in general, right? It's showing that the positive sector rotation that we want to see for the overall market to keep moving higher. So this is a really good chart. Okay. All right. Santa Claus rally. So the actual Santa Claus rally dates this year is from December 22nd, which is this coming Friday, to January 3rd, through January 3rd. So that'll be the last trading day in that Santa Claus rally. So I got this from Wikipedia or Investopedia. So Santa Claus rally is the sustained increase in the market that occurs around the Christmas holiday on December 25th. Most estimate these rallies happen in the week leading up to the Christmas holiday, while others see trends that begin Christmas Day through January 2nd. But the idea is that the rally includes end-of-year tax considerations. All of this is happening basically because all the hedge funds and mutual funds and pension funds and institutional investors are resettling everything going into the new year, right? And that's what tends to almost always produce these rallies at the very, very end of the year. Not what's happening right now, just at the very, very end of the year. And this was recognized first by Yale Hirsch. His kid now has taken over the Stock Traders Almanac, but Yale Hirsch coined this Santa Claus rally idea in 1972, and he defines it as the final 5 trading days of the year and the first 2 trading days of the following year. So these 7 days have historically shown higher stock prices basically 80% of the time. Okay, and we're talking about the S&P 500. So 80% of the time, stocks go up. Doesn't mean they have to go up a lot, but they go up. Stock Traders Almanac compiled the data 70 years. Okay, so from 1950 to 2020, Santa Claus rally occurs 57 times with the growth in the S&P by 1.3%. So, excuse me, in 2020, this last year, we had 0.8% over that time period. So not a whole big rally, Santa Claus rally during that time, but the market went up, so it counts as a Santa Claus rally. So we'll see what happens this year. That's kind of the first part of it. The other part of it is this idea of the January barometer. Okay, so the January barometer refers to this idea that what happens in January on the S&P 500 predicts the performance for the rest of the year. Okay, so they say if you get Stock Traders Almanac calls it the trifecta. You got the January, you get the Santa Claus rally, the first week of January, and then January as a whole. Those are the 3. So if you get a Santa Claus rally and the first week of January is positive and the month of January is positive, then almost always the rest of the year is positive. So pretty interesting stuff, actually, because the odds are really good if January does well that the market keeps moving higher. Okay. I was watching a interview on stockcharts.com, Stock Charts TV, with Jeff Hirsch, who's the son now that's running Stock Traders Almanac, and Dave Keller from stockcharts.com. And this is pretty interesting. So we have a sitting president that's running, right? So this is the average going, from 1949 to 2022 during election years. This is what the pattern looks like. So in the years where you have a sitting president running, January tends to be really strong, right, into February. So it's going to be interesting to see what happens. So first of all, betting against the market in a year when you have a sitting president running is not a good idea. Certainly with the huge rally we've had, back here, we would expect some kind of pullback. You're not going to go straight up in a straight line for the year. That's ridiculous. So we'll get some kind of pullback at some point, and it's likely to happen, February into March. perhaps earlier or later, whatever. We'll get some kind of pullback. What I think is going to be really interesting is what happens in January. Because if we actually get a significant pullback in January, in a year where you have a sitting president running, I'm wondering if the market is sniffing out that the sitting president does not end up running in the end. That's my that if I was going to Vegas, that's what I would figure out a way to play that in Vegas. So yeah, we don't have, it's not an open field, obviously, which that's the worst, because it's the market doesn't like absolute uncertainty, and that's what that is. I wish it was an open field, but it is what it is. All right, so I thought that was pretty cool. C fund and the F fund. So kind of two takeaways here. If you were at if you were doing practice questions for the Chartered Market Technician test, let's say, they could throw this chart up and say, identify what the pattern is here, and would you buy this pattern or would you sell this pattern? This is a really, really good cup and handle. Okay, it's a really basic pattern, and once you get above, you could either say once you get above the handle, or if you want to be really certain about it, you get above the cup, which we are almost there. That's basically puts us at new all-time highs on the S&P, but we're almost there now. We had this monster rally out of this handle. This pattern is saying that price keeps going higher. If you just looked, if you didn't know anything else and you looked at that, you would be, oh, absolutely, that's a buy. That was the buy right there. In fact, this week is where it cleared that handle. So this was the buy week in this pattern. So from that pattern perspective, it's an extremely strong buy. And it's a weekly chart. It's a long term, right? We're going back to 2020. So it's not a timing tool as far as, is the market going up or down tomorrow? But in a long term chart, that is a very well recognized, acknowledged pattern, cup and handle. In the short term, obviously, there's a long way down between where we are now and that 20-week moving average line. And the other one I just want to look at is the F fund. So we've been talking about the F fund for months. And I wanted to do the chart all the way back. So we're back here sometime in 2003, okay, where the AGG began. That was 102, right? Let's say it opened up at 102. If you had invested in the F fund when it at its inception at 102, and you held it until 120, you were up about 20%, right? Since then, you lost the entire value of whatever gains you had in the F fund. They were all gone as of kind of the middle of 2022. It was gone. By a couple months later, we're almost down to where we were in 2008. I mean, we talk about it a lot. This bear market in bonds is unbelievably historic, okay? But it set up a really, really good 5-wave Elliott wave pattern to the downside. And we've been talking about it for a long time. 1, 2, 3, 4, 5. And we got this 5, this bottom, and for the past couple of months, the F fund has been rocketing higher. I mean, it's regained, months of losses in the past few weeks. So a lot of people ask, what's the point of Elliott waves? Like it doesn't. A lot of people have a hard time with Elliott waves, and I don't really use it as sort of a timing tool. It's much more of a pattern recognition tool. So now that we know we have this 5-wave pattern complete.
So the difference really would be the difference between prediction and confirmation, right?
Yeah.
You're not using it to predict what may happen, but confirm where the trend is at a given time.
Yeah, like if you have 5 waves down, there's a very high probability that you are at a significant bottom. Much more so than in the same way, if you have 5 waves higher, you're much more likely to be at a significant top. Until you're right, you're using it to confirm, but if you can get down to, you get 5 waves down and you get some kind of Fibonacci retracement at that same level, that is the best place, at the least risky place. Because if it blows through that level, you just get out because
the probability high, the risk is low. It's about the best you can get.
Yeah, and the F fund in particular. So like we don't use the F fund very often, but in this case, it's so oversold. I mean, once that 5 wave was in, and again, we've been talking about it for a long time. Once we got below this 3, anywhere in there, the 5 doesn't have to. It only has to get below the 3. So, I was like on the edge of my seat, waiting to get some kind of confirmation on an upturn, to get into both the F fund and long-term Treasury bonds, because it's just this historic bottom. I mean, if you compare that, the amazing thing is you compare that to the C fund, and we're at, again, basically at all-time highs. So the value, if people talk about buy low, sell high kind of thing, the C fund here, now, given we just talked about this really good cup and handle pattern, and so I'm not saying that this isn't a pattern to buy, but it's a different way of looking at the world. This is actually, if you were an Investor's Business Daily kind of guy, if you followed that, this is a perfect buy, because from their perspective, you want to buy when the market is breaking out of a consolidation pattern, which cup and handle is a great consolidation pattern, and once it breaks out, there's no resistance. There's nothing pushing down on it. So you want to buy high and sell higher is the idea from Investor's Business Daily. But a lot of people say, no, you want to buy low and sell high. How do you know if it's low? If you get 5 waves down on a time when bonds have never had 3 consecutive down years, that is about as low. It's not about as low as you're going to get, but that's a really good way to count to estimate how low you are. And so it just amazes me that both of them are exploding at the same time, which is basically why we're invested in the percentages that we are. All right. A lot of stuff in there. If you guys have questions, definitely let us know. Questions? Keep forgetting to go to that.
As always, if you have questions, you can put them in the comment section wherever you find the video. If there is no comment section where you find the video, then just shoot us an email to support@growmytsp.com. The support team will get it over to us. We have it all happen all the time.
Yep.
They'll push it over. We'll get the earliest opportunity we can to answer, then they ship it right back to you. It's a nifty little system.
We got a good question, or not a question, but something I missed. TSP apparently is changing the iFund in 2024. So I haven't had time yet to really dig into that. I didn't think it was going to be very hard to come up with an ETF that tracks that index, but so far I haven't found one. So if there is one, either an ETF or a mutual fund, I'll find it. And if it's only an index, you need a way to get that onto a chart. It would be really annoying if we couldn't come up with a way to put it on a chart.
Yeah, well, but I have a feeling once it gets confirmed, not necessarily confirmed that it's happening, but closer to when it's happening, so, somebody will put together an ETF, somebody will put together a mutual fund that kind of matches that if they haven't already.
There's an all-world index. There's an all-world ex-China, but this new one is all-world, ex-US, ex-China, ex-Hong Kong. I'm like, okay, I mean, whatever y'all want to do, but just let me be able to chart that
Whatever floats your boat, but
Yeah.
somebody give me an ETF.
Yeah. So we'll talk about that next week.
All right. I hope you guys have a great week. Hope you're getting ready for the holidays. Families are doing well, and we will see you soon.
Out of here.